Can you simplify what Taro is? Because that'll essentially enable stablecoins on top of Bitcoin, right?
Yeah, so well, the funny thing is Tether started on top of Bitcoin on Omni, and eventually it migrated onto other things that were more suitable for it. Taro is a protocol proposed by Lightning Labs that's based on the Taproot soft fork that allows them to put assets on Bitcoin and Lightning. And so if that's successful, the most obvious use case is stablecoins, because in theory the Lightning network is one of the best places to have stablecoins because it's so fast and cheap compared to even the altcoin undecentralized networks. This one, it runs on Bitcoin base layer, but then you get the speed that's rivals any of the altcoins out there. And so I think that's, all else being equal, I'd rather see stablecoins on Bitcoin than elsewhere.
For sure. The Luna situation, I think, it prompted questions about Tether and whether there was going to be a run on the bank with Tether. But some people said that, essentially the network has shown resiliency because people were trying to cash out and they were able to. So any thoughts on Tether?
Well, that shows the difference between a fiat collateralized stablecoin and an algorithmic one. And so I've not been raising warnings about Tether the same way I was raising warnings about Terra. I think that there are still challenges about collateralization, for Tether, because you can think of a stablecoin as being one of two models. If your assets and your liabilities are like identical, like the same amount, then your assets better be risk-free, because if you lose any percentage of them, you're now underwater. On the other hand, you can have more like a bank model where you can take some risk with your assets, but then you better have a capital buffer. Like your assets should be bigger than your liabilities, so even if you lose a percentage of them, you don't go below your liabilities. And so we see a lot with like USDC, they shifted over to be 100% cash and T-bills, and Tether's kind of moving in that direction, where right now they still have that mix of other collateral, but then we don't know if they have a capital buffer. And so, personally, I would rate Tether below USDC in terms of, say, the assurances that it's a, perfectly one-to-one pegged in all conditions. But I don't have the same kind of total systemic concerns about it the same way that I did with Terra Luna.
What do you think should happen when one of these essentially experiments within crypto fails and people literally lose their life savings?
Well, I think there's a difference between an experiment and something that actively preys on people. I mean, I was talking to someone here from Argentina, and they were saying a lot of Argentinians that don't have a lot of money got caught up in this, right? So they saw 20% yields, and they're like, and not everybody's financially literate. And then there's a trap. I mean, in a lot of markets, because of high inflation, 20% yields are not uncommon. Right. Even, of course, 20% yields on dollars should raise some red flags. And so a lot of people just didn't know the difference, and they bought into it. And it's because it was marketed as a stable coin. It was marketed as something that's not speculative, even though anyone who actually understands the technical details understood the risk. Right. But not a lot of people can be expected to. So I think there's a difference between saying, here's a proposal, here's some cool ideas, versus actively pulling people in with purposely artificial yields that are VC funded to try to make it as big as possible. That's different than just an experiment. So I think that has more legal implications because you're preying on people.
Well, I think that a lot of people are looking for that yield because of the situation we're in, because inflation is so high and people are feeling left behind and squeezed in every direction. So let's talk a little bit more about the market sell-off and the bigger macro picture, because your main newsletter focused on the Fed sort of being in this position of trying to tighten because they really need to, but trying not to spark a recession. Yes. So can you talk a little bit about what you're seeing right now and where you think this is going to go and maybe how it's going to play out in 3 to 6 months?
So historically, the Fed tries to tighten when inflation's running above their targets and when the economy is doing pretty well. And then if the economy is weak and it's disinflationary, them and then also the fiscal authorities can collectively print money and basically reinflate things and ease monetary conditions. And the challenge to that model is when you have stagflation, which is you have high inflation, but also you have economic indicators weakening. Not the main ones like unemployment yet, because those operate on a lag, but kind of the leading indicators are already weakening. So this is actually a point where they would normally kind of already have been tightening and have now maybe would stop tightening, and they're just starting to tighten. Yeah. And if you look back in history, kind of these gigantic regime changes in policy happen when you have inflation, but then due to so much debt in the system, you can't tighten as much as you'd want to, that you maybe need to. And so I think ultimately that's what's going to happen, that they're going to try to tighten until something doesn't work out, something breaks in markets, or we enter a persistent recession, and they're forced to maybe stop tightening even when inflation's still hot. And I think that's kind of the the quote-unquote end game of this kind of structural cycle where they're just unable to tighten despite high inflation.